Welcome to the deep dive. Today, we're really getting into it, comparing two very different ways to build a portfolio.
That's right. We're looking at the classic 60-40, 60% stocks, 40% bonds, against something pretty radical. 30-30-30, stocks, gold, and Bitcoin.
And this isn't just about numbers, is it? It's more like examining a fundamental shift in how people might be thinking about investing.
Exactly. It's a debate about which future you're actually betting on.
Yeah.
The 60-40, well, they came out of a specific time disinflation, falling rates.
Right. The good old days for bonds, maybe.
You could say that. Whereas this 30-30-30,
Yeah.
it's a clear response to worries about ongoing inflation and maybe broader financial instability.
Okay, let's start with the bedrock then. The 60-40, where did it come from?
Well, its roots are in modern portfolio theory, MPT Markowitz. The whole idea really is diversification based on low or ideally negative correlation between assets.
Meaning you want assets that don't move in the same direction at the same time.
Precisely. And the 60-40 thrived because for, almost 40 years, bonds did exactly that relative to stocks. They were the reliable zig when stocks zagged. That was the theory.
Theoried and, for a long time, practice.
Until it wasn't. 2022 was a rude awakening. We saw high inflation, rates went up sharply, and boom, stocks and bonds fell together. Hard.
So that negative correlation, the cornerstone, just crumbled.
It did, which exposed the 60-40's big vulnerability.
Yeah.
A regime change, a shift to inflation.
Okay, so if the bond hedge is broken or at least unreliable in this environment, people start looking elsewhere. Which brings us to the 30-30-30. Scarcity seems key here.
That's the core thesis. This portfolio basically says, forget rate-sensitive bonds. Let's focus on assets that are inherently scarce and might hold up better if currency values erode.
Right. So let's break down its parts. You've got 30% VTI.
Yep, Vanguard, total stock market ETF, broad exposure to the U.S. economy, the growth engine, standard stuff.
Then 30% GLD, gold.
Correct. The physical gold ETF. Think of it as the hard asset anchor. Historically, gold correlation to stocks is almost zero, like MAT is 0.01 or something tiny. Plus, it's the traditional hedge against, currency issues.
Okay, VTI for growth, gold for stability and inflation hedge, and then the last 30%, Bitcoin, BTC.
Ah, yes, Bitcoin. That's the real wild card, isn't it? It's positioned here as, well, two things, really. A high-growth, speculative play, and a hedge against the traditional financial system itself.
Because of its fixed supply, that 21 million coin limit.
That's fundamental to the argument. So what you end up with is diversification across, different systems.
Yeah.
You've got the corporate economy with VTI, a sort of non-sovereign monetary asset with gold, and then the decentralized digital world with Bitcoin.
Interesting way to frame it. Diversifying systems, not just assets, but performance versus risk. That's the big question, especially with Bitcoin.
Absolutely. And the back tests, well, they're eye-popping. From 2020 to 2024, the 30-30-30 model showed a compound annual growth rate of about 36.4%.
36%? Wow. Compared to the 60-40s.
8.3% over the same period. So, yeah, more than 4 times higher.
Okay, hold on, though. 36% CAGR is huge, but 2020 to 2024 included a massive bull run for Bitcoin specifically, right? Isn't that skewing things? And what about the ride? It must have been wild.
Oh, incredibly volatile. That's the trade-off. Stark naked. That outperformance is the risk. Bitcoin's annual volatility is often somewhere between, say, 80% and 120%. Compare that to the S&P 500's 16-20%. It's a different beast entirely.
4 or 5 times the volatility. So that 30% allocation, that's not what standard portfolio theory would suggest, is it?
Not even close.
Yeah.
This is where it really departs from MPT. Academic work looking at, optimizing risk-adjusted returns. Sharp ratio suggests a Bitcoin allocation of maybe 1% to 6%. COPS.
It was 1 to 6%.
Right, so putting 30% in, that fundamentally changes the game. It's moving away from managing risk, from maximizing that Sharp ratio, towards outright speculation. You're chasing those huge potential gains, the right tail, even if it means accepting massive potential drawdowns, the left tail.
So it really boils down to this. Choosing between 60-40 and 30-30-30 is making a strategic bet on what the next decade or two looks like economically.
Precisely. The 60-40 is, you could say, prudence defined by the past 40 years. It's a bet on things going back to, normal stability, maybe falling rates again eventually.
While the 30-30-30 is a gamble on a fundamental shakeup in finance where inflation persists and maybe traditional systems are less reliable.
It's certainly a high conviction bet on that kind of future, accepting extreme risk for potentially exponential rewards.
Yeah.
Which leads to a final thought for you, the listener, to ponder.
Okay.
Think about what these portfolios are actually made of. The 60-40 is entirely financial claims. Stocks are claims on corporate earnings. Bonds are claims on future payments. Promises, denominated in fiat currency.
Right.
That the 30-30-30, on the other hand, is 60% invested in scarce assets, physical gold, and digitally scarce Bitcoin. So the question is, what does it signal about an investor's confidence in the future value of those financial promises when they deliberately choose to hold a majority of their portfolio in scarce things instead?